The US economy has somehow avoided a recession against many people's predictions. Risk assets have rallied, and the labor market has held up against rising interest rates, insane housing conditions, and uncertainty around every corner. However, it looks like it's all starting to catch up as we are starting to see massive outflows from risk assets. Couple that with more interest rate hikes coming as early as July and a ticking time bomb in the commercial real estate market, the next few months will be very interesting. There's one thing we need to understand. Central banks are on a mission to get inflation down. Jerome Powell made that very clear during his meeting yesterday as he said more interest rates are coming in 2023.
The strong majority of the committee believes that it will be appropriate to raise the federal funds rate again once or twice by the end of the year. A strong majority came down on twice between now and the end of the year.
Now, the US is not alone in this fight against inflation and raising rates. It seems like every central bank is following suit. We can see that almost all central banks are tightening their standards because inflation is just out of control. You can see that the UK raised by 50 basis points more than expected. Switzerland also raised, Norway, Turkey, and the US says that they have 2 more coming. Why? Because inflation is still a problem all over the world. And to paint the picture a little bit better, you can see on this chart basically all of Europe and especially Turkey, they've been raising rates since the start of 2023 to hopefully fight this inflation. And when we look at it, while the US has been tackling the inflation the best, they're still double what their target rate is at 4%. And we could see that the UK and just Europe in general is struggling the most as their rates are currently sitting at 6%, with the UK topping everyone at 8.7%. But we have to ask ourselves, what concerns does this bring? Now we know that raising rates slow the economy. It puts a damper on risk assets, and if you tighten too much, then you are at risk of a recession to rise. Now you can see the chief global market strategist at Invesco says, if the Federal Reserve does tighten 2 more times this year, it risks sending the economy into a significant recession. But one take by the global strategist at MRB Partners says that if you're not in a recession, it's also really hard to get core inflation down because you need to weaken the employment sector in order to do so. So it seems like we're at a crossroads because in order to bring down core inflation to the target, there needs to be more pain in the economy, which basically they're hinting at we do need to go through a recession if we really want to get our target rate of 2%. And the markets are actually telling us that investors are worried about recession risks hitting the US hard if you just follow the money. You can see that investors yanked $5 billion from global equity funds in the week, and they put almost all that money into bonds. Now, when there's less money going into equities and more into bonds, that's because investors are weary and very scared of what risk assets will do because, again, they're worried about this possible recession coming with 2 more interest rate hikes coming. If we just go ahead and take a look at the 10-year yields, we know that a lot of money is coming out of equities, and if more money continues to be thrown into 10-year bonds and the short-term yields, obviously those yields are going to go up. And when you take a look at the S&P 500, which we know is considered risk assets because stocks are considered risk assets, when you take a look at the 10-year yields and compare them to the S&P 500, you can see that they have an inverse relationship. Now, what I mean by this is that if we take a look back, anytime, so the blue line is the 10-year yield and the orange is the S&P 500. Whenever we see the 10-year yields rising, or the percentage of them, we could see that equities start to sell off, or the S&P 500 sells off. Now we could see the inverse of that as well. Anytime that right over here, we have a sell-off in the percentage or the interest rate of 10-year yields start to go down from that same exact point right around here, obviously the S&P 500 rallies. And you can see it happen over and over and over again, right? As this blue line starts to go down, then the opposite happens for S&P 500. Now what we're seeing is that there are concerns that the interest rates for these yields are starting to go up, which means that there's going to be more of a sell-off in the S&P 500. And as we just talked about, we know that billions of dollars are flowing out of equities and into the bond market, which means something like this could be coming in the next couple of months. However, Janet Yellen, the U.S. Treasury Secretary, says that she sees lower recession risks for the U.S. But she does hint that in order for it to slow down, we need to see consumer spending going down as well. But the head of strategy at Wells Fargo tells us there's only one way that's going to happen.
So the number one issue is Tech is not going to roll over. The major theme is not going to roll over until you crack the economy. That's what happened back in '99. That's like what's going to happen now. And I don't think you crack the economy until the Fed gets more aggressive. And so we'll have some wiggles. I think we'll have a pullback in the market. We'll have a pullback in big tech. But that overall theme is still in place, and not until the economy breaks do we really think about that trend breaking.
And as mentioned before, you could see the technology sector is seeing $2 billion in outflow. Now, obviously, we know that the tech sector, or basically the entire stock market, is being held together by just a select few stocks. They've been carrying everyone basically the entire year. And we could see, as obviously the last 6 months, the tech sector, or basically all the tech stocks, have been doing extremely well. You can see that here in 1999, as we had that massive outflow or great performance, it was followed by massive outflows and poor performance as, the dot-com bubble happened. While we probably won't see the same effect as the 2000 dot-com bubble, we are going to see somewhat of a slowdown because of interest rate hikes. And as he said before, in order for inflation to get down, we need to see the Fed get more aggressive. And as they get more aggressive, that means the economy is going to start going through cracks, and we're going to see more things start to fail. And to put the cherry on top, commercial real estate is just a ticking time bomb waiting to explode. Obviously, we saw the banking sector stress just a few months ago as we were raising interest rates. Now, the next thing that could possibly happen or follow suit is commercial real estate. Higher rates and falling property values are bringing the commercial real estate market down. In the US alone, about $1.4 trillion of loans may be due by next year, and owners facing those large principal payments may prefer to just default instead of borrowing again to pay it, because as you can see, the trend is just continuing to go down as work from home continues post-pandemic. There's really less of an incentive to have these office spaces or commercial real estate in general. And as we take a look at this chart in just San Francisco, nowhere in the US is the crisis more severe than San Francisco, where tech-fueled properties prices had a long way to fall, and one building after another is slipping into default. And it's not just San Francisco. While this is the worst area because of that huge tech boom, everywhere, every major city is seeing the same exact thing. And while all of this is very concerning, we're going to have to keep an eye on basically the S&P 500 in the market, because as these interest rate hikes, while it's not going to be that much, while it may just be 2 more 25 basis point rate hikes, as we start to see money flow out of equities and into bond markets, we could see the S&P 500 start to roll over. And again, with commercial real estate, that could be the crack in the US economy that really sends it into that recession.